we all know that the transactions are multi-element. One is a sale right then at that point in time. The other one is a sale which will take place at a later stage. So there are many elements in one transaction. The elements could be different in nature also, like you buy a refrigerator and you get credit voucher for a film show, for example, or a ticket to a theater. So there could be some different relationship, like they may not be related to each other with respect to the nature. Analyze from the perspective of the customer. Always look at from the perspective of the customer as to what is he getting. Allocation of consideration issues. The fair value which you are giving as a customer must be split into the sale proceeds for the outright sales transaction and the deferred sales transaction. Now, if I have for example, if I buy a refrigerator and I get a ticket to Dubai, for example, in this transaction, if I'm paying, let's say, 50,000 rupees for a refrigerator, I'm not paying 50,000 rupees for the refrigerator alone. I'm also paying for the ticket to Dubai. So this 50,000 would be split into the fair value of the ticket to Dubai and the fair value of the refrigerator. If it is difficult to do, then you just determine the fair value of the ancillary element, which is the ticket to Dubai, and you take it out. Let's say ticket to Dubai is 20,000. You take out 20,000 from 50,000. The remainder of 30,000 is the fair value. You don't need to check that again. That is the fair value, and that is the sale proceeds, and that goes to P&L as revenue. The remainder of 20,000 would be deferred and would be taken to P&L at the time when the ticket is actually sold or used by the customer. So if I use that ticket 1 year later, the revenue would be booked at that time. That is the idea. And if there are forfeitures, obviously there are lapses in the points and the schemes. Those forfeitures have to be estimated and reversed. The revenue would be reversed whenever the likelihood arises that the points would lapse. And the changes in estimates is possible. Variety of programs, variety of awards, effective from period July 2008. IFRS 14, limit on defined benefit asset. Slightly complicated. I would try to quickly run through it. It further clarifies the asset recognition criteria under para 58 of IS 19. Now, if you recall IS 19, what it says is that if there is a surplus in asset, if there is a surplus in fund, like you have present value of obligation and present value, fair value of assets, and the difference is either a shortfall or a surplus. So if there is a surplus there, and if you have a receivable from the fund also on the balance sheet, then can you recognize that asset and reverse that, pull that surplus back into the company? Can you do that? So there are very stringent rules for that. You can't just outrightly do that. If the conditions are met, yes, you may be able to do that. What the conditions are: the present value of economic benefits may be difficult to estimate. It could either be a refund or reduction in future contributions. So if I legally can get a refund from my pension fund back into the company, if that is allowable, then only I can recognize it as a receivable, or I can book the benefit today. Or if there is a reduction in future contributions, like I know my future contributions would be reduced because of this, then I can recognize this asset. A refund would be recognized if the refund is permitted under the terms of the plan. First of all, plan must allow that the refund is permitted. Now, this amendment is important in Pakistan context because we have seen many accounts whereby the refund is recognized without looking at the conditions. So if there is a surplus in the fund, it is taken back into the company. So you can't really do that right away. You need to follow some conditions on that. A refund would be recognized if the refund is permitted under the terms of the plan is realizable during the life of plan or on settlement will be recognized net of any associated cost. So if there are going to be any cost incurred, would be netted against. No discounting of refund amount permitted, because in the IS 19 there are already too many discountings done, so you don't need to discount it further. So that was for the refund. As we said that it can either be in the form of a refund or can be in the form of reduction in future contributions. So now the reduction in contributions. It would be recognized if there are no minimum funding requirements and the asset would be restricted to PV of future service cost. Now if there are no legal bar on the, there is no minimum funding requirement for the company to meet in the future years. If there are minimum funding requirement, then definitely you can't take money back, because you, under the law, you are required to make contributions, minimum contribution into the fund. But if the minimum contribution requirement is, let's say you estimate is 100 rupees in the next 20 years period, whereas the amount which you determine, which you can get back as an asset is 200 rupees, for example. So I can't record 200 as an asset today, because I know I must pay 100 rupees into the fund as a minimum requirement. But the remainder of the 100 can be recognized as an asset. So that is what it means. In case of minimum funding requirements in respect of future service costs, the reduction in future contributions would be restricted to the excess of economic benefit amount over the minimum funding requirement. So as I said, if I know future cost would be 100 rupees, so I just take the difference and book the difference in my balance sheet. In case of minimum funding requirements in respect of past service costs, the reduction in future contribution would be considered after the amounts have been paid. Like if I have past service cost, but I have not paid that into the fund, and this would be paid through minimum contributions in future years. So I cannot recognize an asset as of today. First, I will contribute all those funds which relate to past service costs into the fund. And once the fund has it, they value themselves again, they book the difference, and then I will reassess at that point. So that was IFRIC 14. IFRIC 15, if there are any questions? No question. Agreements for construction of real estate. This is also relevant in here, because this relates to real estate business. And in construction of real estate projects, a question arises whether the sale of units, the IFRIC refers to units. Like you have a residential plaza containing 300 units. Now the sale of those 300 units falls under IS 18 or under IS 11. IS 18 means you book it as a revenue. IS 11 means you apply construction cost accounting, proportionate profits be booked into the P&L. So this clarifies that confusion. Determine whether arrangement contains multiple elements. So first of all, you would see whether the whole, let's say, plaza comprises of multiple elements. Like for example, you have some commercial shops at the basement or in the first floor, which are sold under IS 11, and or IS 18. There could be some penthouses which could be sold under IS 11. There could be some units which could be sold under IS 18. There could be some ancillary equipment which could be sold like an equipment, like you sold some generator or some other facilities to the unit holders. So you will apply a different, so there have to be multiple elements. There could be multiple elements. You need to segregate them all. Then allocate fair value to each component. Obviously, once you deal, go in a deal for many items, you need to allocate fair values for each component. Determine if IS 11 or 18 applies to each component. Buyer is able to specify. Okay, this is the deciding factor. If the buyer is able to specify major structural design before construction then it would be IS 11. If buyers limited, it has limited ability to influence the design, it would be 18. The example is very relevant. For example, if we agreed with the buyers that these would be the designs and layouts and furnishings and everything else, and they all agree on, they could be 2 or 3 model designs, so they all agree on one of those models. They can't influence any changes in the structural design, then it is sale under IS 11. Is sale under IS 18. But if they can change the structural design, if the buyer comes and tells me, no, I don't want this room here, I want a lobby here and things like that. So if the structural design can be changed, then it is not IS 18. It is not a transaction whereby you're delivering goods, whereas you are actually conducting a performance of a contract. So that falls under IS 11. So analyze transfer of risks and rewards, rendering of services. If it is like construction contract, then percentage of completion method is followed, or sale of goods, recognize revenue when significant risks and rewards transferred and no continuing managerial involvement, plus there's some other conditions. Okay, for this again, there is a handout which you can refer to later on, which simplifies. It is part of IFRS also. All the conditions are laid down, and it helps in deciding as to whether IS 18 should be followed or IS 11 should be followed. IFRS 16 hedges of a net investment in foreign operations. This amendment is also, this interpretation is also not very relevant in Pakistan. This provides guidance on the risk being hedged should relate to difference in functional currencies between any parent and its subsidiary. The hedge risk cannot relate to the group's presentation currency. Like if as a holding company in Pakistan, I want to hedge a currency risk of a subsidiary based in Sri Lanka or some other country, this provides guidance. I can do that as long as the hedging is possible. But what I cannot do is to hedge the presentation currency risk, like rupee risk, in my consolidated accounts. I can't hedge my own presentation currency risk. It can only be the difference between my presentation currency and the functional currency of my subsidiary. So the hedging relationship can only establish if my subsidiary is, let's say, in US dollar, the functional currency is dollar, my functional currency is rupee and presentation is rupee, so I want to hedge the subsidiary's dollar risk. That is allowed. But what I cannot do is to hedge my rupee risk and book revenues or income on that. So the relationship has to be there. The parent may not be the ultimate parent, it can be an intermediary parent also. Hedging instruments may be held anywhere in the group apart from the subsidiary that it itself is being hedged. Most hedging strategies used in practice will continue to be permitted by the interpretation. Most entities will not therefore face any challenge, any change from applying it. IFRS 17, distributions of non-cash assets to owners. This is the last IFRS. Okay, this clarifies that a dividend payable should be recognized when the dividend is appropriately authorized and is no longer at the discretion of the entity. Where an owner has a choice of a dividend of a non-cash asset or cash, the dividend payable is estimated considering both the fair value and probability of the owner selecting each option. An entity should measure the dividend payable at the fair value of the net assets to be distributed. An entity should recognize the difference between the dividend paid and the carrying amount of the net assets distributed in profit and loss. The interpretation also requires an entity to provide additional disclosures if the net assets being held for distribution to owners meet the definition of a discontinued operation. I hope it is clear. In foreign, a distribution to owner can be in cash or in kind. In Pakistan also it is possible, but it is not seen happening. So if the distribution is in cash, there is no question. But if there is a distribution in kind, and if that distribution is in kind is available to all shareholders equally, then it falls under this IFRS distribution. If the distribution is only for few investors or few, let's say, holding company shareholders, or holding company is only entitled to an asset to be paid, to be given instead of the cash, and the rest of the shareholders would still get the cash. So this interpretation would not apply. It has to be a distribution whereby all the shareholders have a right. So the company would have to measure, would see the likelihood of shareholders opting for the asset, and what would be the value, what would be the fair value. So recognize dividend at that value, any differential would go to P&L. Okay, finally we have improvements, and the 2008 improvement project, which is out and which is applicable effective 2009, is summarized here in handout 9. So if you just refer to handout 9, I think it would be easier. You know, ISB is running these improvement projects along with their other major projects. And these improvement projects are basically considered to be essential, that all the IAS and IFRS should be reviewed annually for any amendments, maybe minor or major. So minor amendments are considered, are taken up in this improvement project, and major amendments are considered for proper project. So this project includes, because it's an improvement project, it includes various minor amendments which have been clubbed together. And in the next year, 2009 improvement project also, there are various minor amendments clubbed together. So in this 2008, in IFRS 5, there is an amendment that if all of a subsidiary's assets and liabilities are classified as held for sale, if a partial disposal sale plan results in loss of control. So if we hold 51% stake in a subsidiary, we also hold the control also. That subsidiary is consolidated, is a business combination, whatever. Now, if we sold 2% of that stake, logically, we are not going to sell, we may not sell remaining 49% of the stake. So why IFRS 5 should be applied on the remaining 49% of the stake? What do you think? Why should it be applied? The amendment requires that once you lose control, you sold 2% of the stake, now you classify the remaining 49% of the stake as assets held for disposal. So does it make sense? No. If the subsidiary described above is a disposal group meeting the definition of a discontinued operation, the relevant disclosure should be made. A consequential amendment to IFRS 1 has been also made. So that's how the framework is actually coming out. As I said in the beginning also, business combination follows a particular methodology and a framework. IFRS 8 is another example. Now this is another example that in a consolidated statement, if you are losing control of a subsidiary, you are actually giving it away. So you must disclose the rest of the portion, because your intention is that you lost control. So it must be reflected. It's not just that you dispose of 2% and you retain 49% as usual. No, the economic substance is that you're losing that subsidiary. So you must show that as a asset held for disposal. I-16, property, plant, equipment. Entities whose ordinary activities comprise renting and subsequently selling assets present proceeds from the sale of those assets as revenue. Like previously, we used to record that as other income. Now it is revenue. Why other income? Because if I have a building, it is rented, that rent income becomes my revenue, right? But subsequently, if I decide to sell that building, that gain comes as other income. Now this amendment requires that that gain is not other income, that is also part of revenue. The carrying amount of the asset is transferred to inventories when the asset becomes held for sale. Now this is also important, that you classified that as property, plant, equipment. Now you want to sell it, so the moment you decide, you transfer it from property, plant, equipment to inventories. So you sell it and you make profit. A consequential amendment to IS 7 states that cash flow arising from purchase, rental, and sale of those assets are classified as cash from operating activities. Wording of definition of recoverable amount has been aligned with this, so nothing major. IS 23, borrowing cost. Definition of borrowing cost has been amended. Interest expense is calculated using the effective interest method defined in 39. Oh, you don't have the handout? So, very minor amendment in borrowing cost. In consolidation, where an investment in a subsidiary that is accounted for under 39 is classified as held for sale under IFRS 5, IS 39 would still be followed. Now, what it essentially means is that, now keep this concept in mind, that whenever an investment is valued under 39, it is the best standard to value an investment. Be it an investment in associate, be it in a subsidiary, well, subsidiary doesn't fall, be it a joint venture or a routine investment other than associate. The moment you classify it as under 39, this is the best standard. So you don't need to comply with any disclosure requirement. And the next amendment, you would see that a lot of disclosure requirements which were required for associates are no more required if those associates are valued under 39, because 39 is the best model. It takes care of everything. It is fair value model. You just classify it at fair value, forget about you follow IS 28 for associates if you want to follow cost model, right? If you don't want to follow cost model, then don't apply IS 28 on your associates, just bring it under 39. AFS category available for sale. So the 39 is the best model. Here again, if you are following 39, keep continuing, because IFRS 5 is essentially 39. It follows 39. All the other IFRS are actually tracking 39. Just must try to see the relationship between 39 and the rest of the IFRS or the IS. IFRS 39 is the leading IFRS, and the rest of the IFRS are actually tracking IFRS 39. So if there is a change in 39, there are many changes in other IFRSs. If there is a methodology revised in 39, the methodologies are revised in other. Like for example, in 23, the first one, 39 talks about interest, the effective interest method. 23 was not following that, so punish 23. 23 must change. 39 will not change. So just keep that in mind. You will never get distracted. I'm giving you this this tip. 39, as long as 39 is being followed, this is the best model. Forget about any implications, no implications. But if you are deviating from 39, then you try to go for other standards, IS 28 for associates, IS 29 for 31 for JVs. So if you want to follow cost model, then you go there. Why otherwise? So IFRS 5 also is tracking 39. As you can see, IFRS 5 requires assets held for disposal to be valued at fair value. To be valued at fair value, less cost to sell. So 39 again takes the lead there. Okay. Now look at this amendment, 28. Where an investment in associate is accounted for in accordance with 39, only certain disclosure requirements are required. All the rest are gone. So, why? Because if we are following 39, this is the best model. Why should we follow 28 then? So 28 does not require any extra disclosures. 28 would only require extra disclosure if you are following cost model. An investment associate is treated as a single asset for the purpose of impairment testing. Any impairment loss is not allocated to specific assets included within the investment, for example, goodwill. So because that is one asset, so that does not get further allocated. Reversals of impairment are recorded as an adjustment to the investment balance to the extent that the recoverable amount of the associate increases. I think this is simple. IS 29 amended guidance to reflect the fact that a number of assets and liabilities are measured at fair value rather than historical cost. Nothing significant. 31, again, same principle, where an investment in JV is accounted for in accordance with 39, only certain disclosure requirements need to be made in addition to the disclosures under 32 and IFRS 7. 36, where fair value less cost to sell is calculated on the basis of discounted cash flows, disclosures equivalent to those for value in use calculation should be made. 38, intangible assets. An asset may only be recognized in the event that payment has been made in advance of obtaining right of access to goods or receipt of services. So intangible allows an asset to be recognized if a payment has been made in advance for obtaining any right. Advertising and promotional activities included mail order catalogs can be recognized now. Previously, they were not possible to be recognized. Deletion of wording that states that there is rarely, if ever, support for use of a method that results in a lower rate of amortization than the straight line method. So amortization method reflects the expected pattern of consumption of economic benefits of the asset. So some minor amendments in 38. The second one essentially means that if you look at the next column, expenses incurred in printing mail order catalogs, for example, are recognized once the catalogs are printed and not when they are distributed to customers. So now you can recognize that once at the time when the catalogs are printed. Eliminates a potential interpretation that the unit of production method is probated. So previously, unit of production method was potentially probated, but now it is clear that can be followed. Okay, next one is 40. Property that is under construction or development for future use as investment property is within the scope of 40. So if it is under construction also, now what is the implication? Previously, if it was a ready property, you could classify under 40. Now, if it is under construction, you can also classify it under investment. What is the implication? Fair value, you recognize gains, you recognize huge gains on land. You just acquired land, you start construction. Now you want to make gains out of it, you book it out under investment property and you reflect it on balance sheet. Where the fair value model is applied, such property is therefore measured at fair value. Where the fair value of investment property under construction is not reliably measurable, the property is measured at cost until the earlier of the date construction is completed or the date at which fair value becomes reliably measurable. So more property under construction will be shown at fair value rather than cost. 41, I think not really relevant, we can skip that. 19. Okay, the amendment says a plan amendment that results in a change in the extent to which benefit promises are affected by future salary increases is a curtailment. This is just a clarification. Actually, these are all clarifications. Unless you look at the main text or the body of the IS, you won't really appreciate what is the amendment. So an amendment that changes benefits attributable to past service gives rise to a negative past service cost if it results in a reduction in the present value of defined management obligation. Definition of return on plan assets amended to state that plan administration cost be deducted in the calculation of return on plan assets only to the extent that such costs have been excluded from measurement of the obligation. The distinction between short-term and long-term employee benefits is now based on whether benefits are due to be settled within or after 12 months of employee service being rendered. So if there are short-term and they're going to be settled within 12, then only it becomes short-term. Deletion of guidance that states provisions, contingent liabilities, contingent assets requires contingent liabilities to be recognized. So it's just consistency. Okay, IS 20 again for government grants. The benefit of a below market rate government loan is measured as the difference between the carrying amount in accordance with 30. Again, you see 39 is the leading here. The benefit is as accounted for in accordance with IS 20. And now the 39 itself. The amendments in 39 clarification that it is possible for there to be movements into and out of the fair value through P&L category where a derivative commences or ceases to qualify as a hedging instrument in cash flow or net investment hedge. Because from the wording of IS 39, it looks that there cannot be any movement from these categories. So the movement would be when a derivative initially was, let's say, it qualified for a hedging instrument, now it does not. So there would be a movement there. Financial assets are reclassified following a change in policy by an insurance company according to IFRS 4. The definition of assets or liability at fair value through P&L as it relates to items that are held for trading is amended. This clarifies that a financial asset or liability that is part of a portfolio of financial instruments managed together with evidence of an actual recent pattern of short-term profit taking is included in such a portfolio on initial recognition. This talks about fair value option, and it is just a clarification for that. Removal of a segment as an example of what may be considered a party external to the reporting entity. For hedging itself, there was a wording like the hedging must meet this criteria, and the criteria was that the hedging must be outside the entity or the segment. So the segment wording was unnecessary there, so they removed that. It's only the entity. If it is outside the entity, then it is a hedging. If it is within the entity, that doesn't make sense. So it means that segments can also hedge themselves. When remeasuring the carrying amount of a debt instrument on cessation of fair value hedge accounting, the amendment clarifies that a revised effective interest rate calculated the date fair value hedge accounting ceases are used. So it's a slight amendment in the way the effective interest rate is calculated. IS 1 clarification that some rather than all financial assets and liabilities classified as held for trading in accordance with 39 are examples of current assets and liabilities. Financial assets and liabilities that are classified as held for trading are classified as current or non-current in accordance with IS 1. So under IS 39, if you classified assets under held for trading, there can still be some non-current items, and you need to reclassify them as non-current on the balance sheet, because the balance sheet classification requirement is current and non-current. So if a trading, previously it was a presumption that the whole trading category must be classified under current assets. So it clarifies that there could be non-current assets, because you can practically classify any kind of asset, whether LNR, HTM, or any shares, under trading category now. So that's why it clarifies. These are the future next year improvements. There are some clarification. The first one is again a clarification. The second one is a clarification. The third one, clarification that the hedging gains losses would be reclassified when the hedge transaction takes place. If you remember the recycle from other comprehensive income. Then bifurcation of an embedded foreign currency derivative not required, again a clarification. IFRS 2 confirmation that that acquisition of goods under combination of business on formation of JV and common control transactions are not within the scope. Again, just a clarification. Clarification that the largest unit permitted for the impairment testing of goodwill is operating segment before aggregation. So impairment testing should be done before aggregation. We learned that. IFRS 8 disclosures only require the asset disclosures if they are provided in. I mentioned there that in the 2009, the assets have been deleted from the must disclosures. I7 clarification that expenditure is classified as investing only when it is an asset recognized on the balance sheet. Relevant to extractive industries and advertising and promotion as well as R&D activities. So now this is important that only when there is an asset on the balance sheet, then the returns from that asset can go through investing activities in the cash flow. Additional guidance in 18 on identification of principal and agent. There is a confusion as to when an agent can, should recognize revenues from the principal. So there is a guidance on that matter. We've discussed the second wave. Third wave, which is expected to be sometimes in 2011 or 2012, in another 3-4 years' time. The major ongoing projects which would be covered, which would be out by then, are consolidation, JVs, ICE 31 is being revised, SME standard is being revised, and it is soon to come out. Provisions, ICE 37 is expected in 2009. Fair value measurement guidances are expected in 2010. Income tax would be revamped and revised in 2010. Leases would be revised 11. Revenue recognition, retirement benefit plans, and insurance contracts, these would be in 2011. So in my personal view, there's no point in buying the bound form of the IFRS. Just keep them making changes because it's going to obsolete very soon. So rely on maybe your soft copies of the revised versions, or if you like the hard copies, then keep on buying every 6 months then. Okay, that's it for the day. Thank you very much. If there are no other questions.
Thank you very much, Fahim, for a very comprehensive and elaborate presentation. I'm sure this document will serve as a reference document for for all of us here. Just for information, we'll put this presentation, we'll upload this presentation on the website. We'll also upload these handouts that Fahim has given on the website as well. Another announcement, if Fahim has not been able to cover IFRIC IFRS 7 in very much detail, so we are planning to hold another seminar on IFRS 7 sometime in April, once we're done with the busy period of March. So with that, I'd like to thank our presenter once again, Fahim, to make a very detailed and elaborate presentation. I'd also like to thank all our participants here for their very active participation. I'd also like to thank our SRC team and our CPD consultant, Dr. Shahida. Before I invite you to join us for dinner, we'd like to present a memento to Fahim, our presenter, as an acknowledgement of his efforts. Right. With that, I'd like to invite you all to join us for dinner, which is held on I think second floor, on first floor the new building.
एक अनाउंसमेंट और है, हमारा अपकमिंग वर्कशॉप नेगोशिएशन स्किल्स पे है. 31st January सैटरडे हमने प्लान किया एंड विल बी सेंडिंग द सर्कुलर्स वेरी सुन, बट सिंस दिस अ फोरम सो आई वुड लाइक टू अनाउंस ओवर हियर एज वेल. So hope to seek your participation. We'll have just 25 to 30 persons to be accommodated in the workshop on negotiation skills that we conducted last year as well, and it was very successful. Thank you.